What's going on, ladies and gentlemen, boys and girls, and children of all ages? Definitely glad to be back in the saddle. This is my first live of 2022, first live and first podcast of 2022. Also, this is my first time coming back ever since, getting rid of COVID. So, as some of you guys and girls know, if you follow me on my Instagram or here my YouTube or whatever, made some mentions that yes, I tested positive for COVID last week, which was a kind of a bummer. So I spent my whole New Year's, in isolation, right? Isolating, getting well. I did get sick. I did have a little fever, all of the good stuff like that. But let me see one time. Let me make sure I go live on my Twitch too. So yeah, did get sick. Had a little headache. I had a little congestion. I lost my voice. That's why I couldn't podcast. I tried to do one tutorial podcast, and my voice was just cracking all over the place. It was just, it was sore. My throat was sore. So definitely, it took a couple of days. Started to feel a little bit better at the end of not the end, but the middle of last week. And I was all cleared up by Friday. So definitely shout out to me, getting that COVID, which one? Which is my? I'm losing my sound. Which one my sound? I think it's right. Here we go. So definitely glad to be back. Glad to see everybody. If you're going to catch this podcast live, make sure you hit that like, subscribe, comment, and share button. And so we're going to have a good conversation today. I missed a lot of information that was coming across with everybody. Things that was coming across in the market. I definitely wanted to sit back and be more active, but I had to take care of myself. Like you say, your health is your wealth. So definitely glad to be back. But so far this week, the S&P 500 posted this worst start to a year since 2016. So we're going to look at all these things and we're going to look at what's next. What's next for the market? Right now, we're in a very weird kind of place I've been paying attention to. So today, we're going to talk about Uber stock. Uber stock had a phenomenal year fundamentally, but technically, the stock really didn't move. It actually had a bad year. Had a bad year technically, but was great fundamental. So we're going to talk about Uber stock, looking at them and see if this could be the 2022 turnaround. Of course, we're going to look at the inflation. We got an inflation report coming out on Tuesday. We're going to look at inflation. Where is it at now? How does that affect everything that's going on? We're going to look at the financial industry rise. What is going on in the financial industry? Because the market last week was down. S&P 500, Dow, tech stocks really got beat up. But you see the financial industry go up in an uptick, with companies like Bank of America up 6%. XLF, I'm sorry, is the financial industry stock, and it, not industry, but ETF, and it did pretty well. So why is that? Let's take a look and see into the financial industry. Is the financial industry set to make a bull run this year? Also, into that, we're going to look at tech stocks taking a big fall. A lot of people are rotating out of tech stocks. We're going to talk about that, why we're seeing that, and will that continue? Also, we're going to look at small cap to large cap, why we're seeing a lot of people rotating out of small cap, going to large cap. What does that mean? Also, because people have 401ks out there, things like that. But if y'all come in, y'all let me know live. Also, we're going to take a look at the jobs report. I don't think we have a jobs report coming up this week for December, but we're going to we had the numbers come out. We haven't seen the official unemployment numbers. Take a look at these job reports because, this is very key. We're going to talk about why that is key into the overall picture that goes into potential rate hikes, to see rate hikes, that we're talking about doing this year. So it's a lot going on, y'all. We're talking about jobs reports, rate hikes, small cap to large cap, the tech stock fall, financial industry rise, inflation, and then will 2022 be the year of Uber stock? What's going on with this Uber stock that's doing very well fundamentally, but not so well financially? So as you guys and girls know, I'm a fundamental person, meaning that I'm going to look at the cash flow. I'm going to look at the income statement, the balance sheet like a broken record. And I'm going to look at those companies. I'm going to look at their competition because Uber's one of its largest competition is DoorDash. Uber's cost $40, which is 220s or 410s. And you're looking at DoorDash is around about, I think, 120, 30 something dollars, if I'm not mistaken. If not 40, I think it was. So why is DoorDash going for $145 and it doesn't even beat Uber Eats? So does that mean that Uber is undervalued? That happens all the time in the market, ladies and gentlemen. So we want to take a look at that. Why did it do such bad but so good at the same time? But ladies and gentlemen, if you haven't done so already and you are checking in live, y'all go ahead and make sure y'all hit that like button, hit the like button that y'all coming in, drop some comments. I'm going to be here for a while. I'm going to talk, and I'm going to see if I can share a link so people can actually come in live who wants to talk live as well. So if you are interested in talking to me live, hit me in one of the comments. I'm on Facebook, I'm on YouTube and Twitch. So hit me in the comments and let me know what you think. What do you want to do? All those things like that. So, but ladies and gentlemen, boys and girls and children of all ages, if you haven't done so already, please go ahead and make sure.
Hit the subscribe button, hit the bell icon, hit that like, comment, and share button.
Once again, ladies and gentlemen, boys and girls and children of all ages, you are now tuned into the Investor Show as always. This is your gracious host, the Prince of Investing, Prince Dykes, coming to you guys and girls live all the way from the beautiful city and state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. And as always, I don't have a lot of time, and I definitely know you guys and girls don't have a lot of time, so we are going to do what? Jump straight into it. So anyway, ladies and gentlemen, let's get into our first topic of the day. We're going to talk about the S&P 500 having its worst year since 2016, SPY, and that January barometer. Let's take a look in here. Let me make sure. All right, year to date. So here we go. Let me pull this up. Let me share my screen here. Let me see what y'all say in the comments before I jump into this. Well, right after I jump into this, how we go? Look at that spot. Yeah, there we go. So yes, that's us right there. Let me get this banner out the way. I'm not going to use this banner today. Let me get this banner out. Give me 1 second to get my stuff together, y'all. All right. So take a look here. Let me see what y'all say in the comments. Pete for life. That's my guy to Phoenix, Arizona. He says, what's up? What's up, everybody? What's good? Prince football Sunday. My Niners is playing for the wild card spot. I got to catch the replay. I feel that. Thanks for tuning in. Pete for life. Pete forever. I meant to say what I said Pete for life for. So, yeah, man, thank you for tuning in. And good job on, I would say, good luck on the 49ers. We'll see. Football season is definitely in full swing. Get ready to head into the playoffs. I will be watching that game tomorrow, Georgia versus Alabama. That's for sure. So I'll be watching Georgia versus Alabama. So here we go. Let me see what y'all got to say. Let's sip and talk with Freeman on Twitch. That says, glad you're feeling better and well, Prince. Definitely, I appreciate that. Definitely, Being 100% honest with y'all, I didn't, take COVID as serious as I should have. I mean, yeah, I'm vaccinated, and I had it for how many years? I'm vaccinated, and I said, man, COVID's been out for 2 years, and I never really had no issues. So why do I have to, I don't know. I relaxed a little bit, and I don't know. I was at the Nuggets game, and that's when it kind of felt like, my symptoms kind of came on. But the crazy part about it is nobody in my family or around me that I know of tested positive. That was pretty crazy. But yeah, thank you for that. That's my guy, Max B. Max B, what's going on, Max B? He said, let's go, OG. What are we talking about today? We got so much to catch up on. I haven't been around in a little minute, so I'm going to get up, and try to catch up everything that's been going on in the market. We're going to look at the jobs reports, look at some stocks, some industries. We're going to be talking about industries today, really, that are set to blow up today. So, yeah, what we got going on. What's going on, Al? That's my guy, Al. What's going on with you today, brother? Al is in the building. Oh, this is my guy, Banky. What's going on? Here you go, Banky Pound. Got to give him that sound right there. Banky Pound said, big shout out to my man, Prince. I look forward to learning the business, my brother, Banky Pound. What's going on, Banky Pound? Y'all shout out Banky Pound, man. That's my guy right there. He's doing big things, The thing about Banky Pound, Banky, he's going to be on the show. We're going to do an episode together. He, y'all check out his YouTube channel. He did 33 years in prison. And I think he's been out now for like a year or two. And he's talking about investing and getting into other things and stuff like that. So, I'm definitely very intriguing story of doing 33 years in prison. How do you start investing? What did you do? What do you do? Right. So we're definitely going to have some fun with that. So hopefully y'all get a chance to check that out learn from that too. Shout out to my guy, Bank Pound. Open Ranks, what's going on, Open Ranks? So Open Ranks says, he said you should reach out to collaborate with Earn Your Leisure and Anton Daniels. They are very large platforms. Please humble yourself. Okay. Well, yeah, I've definitely heard of Earn Your Leisure. I don't know anybody over there. I know some of the guests. Some of the guests has been on this show and been on that show. I don't know any of their producers or anybody over there. But most people that are interested in having me on or doing something with me, they usually reach out to me. So Anton Daniels, I haven't heard of him. But yeah, I'm definitely open to reach out to people, talk to people, and if they're interested in what I do. So yeah. But if you're over here telling me, make sure if you have the connection or something like that, are you over there telling them, right? So make sure you over there, definitely tell them I'm always open to collaborate with people that make sense. So anyway, ladies and gentlemen, this is the S&P 500. Let's get into it. This is the slowest week or the worst start to a year we've seen since 2016. What I have pulled up in front of you, ladies and gentlemen, this is the where are we at? What I have pulled up in front of you, ladies and gentlemen, this is the S&P 500. These are your top 500 companies in America, right? This is the benchmark of finance. Prince, what do you mean by the benchmark of finance? So often, if you created a portfolio, if you brought stocks, how do you know if the stocks are doing good or bad? Some people say, well, Prince, if I make money, it's doing good. But if I lose money, I'm doing bad, right? But is that really true? What is your benchmark? It's just like if your teacher gave you a test and said, hey, take this test. And, you're like, okay, so what's the passing score? They're like, well, we don't have one. You're like, well, okay, what if I get a 90 or if I got a 70? Is that good? What's the benchmark? Everybody know 70 is usually passing. So what's done is people for the year, last year, let's go back 1 year. So what people do, let's take 2021, right? 2021, we started out at 373, right? What the SPY ETF cost, $373. It went all the way up and it finished the year out. We finished the year out about $474. So from 370, almost $100. So roughly about 27% that the S&P 500 has gone up, right? Roughly about 25% the S&P 500 has gone up. So when you look at that, you say, okay, well, the entire stock market, because this takes the top 500 companies like Google, Amazon, Facebook, household name companies, Tesla is in there. So when you take these household name companies, and all it does is it tracks the top 500 companies. So then you have to look at your portfolio or your stock or your investment and say, stock market did 27%. What did my portfolio do last year? And then look at your portfolio. Okay, but my portfolio overall, I'm not talking about, hey, yeah, I had one hot stock or whatever. Your overall portfolio, how did it perform last year? When you look at that overall thing, you're going to say, well, did you perform better or equal to or less than the S&P 500? If you only got 10% back last year, while the market did 25%, that means you underperformed, right? If you did better than 27%, that means, hey, congratulations, you beat the market for 2021, right? So that's what I mean by being the benchmark. You're looking at it, you're tying it into what investments are doing or whatever, right? So now we look at this year so far. So far, the S&P 500 has dropped 2% coming out this year. So when I look at, okay, well, what's going on in America, what's going on in the world, what's going on in the economy, S&P 500 is up, down. So what is up? What is matching or beating the S&P 500 right now? A lot of stocks are getting slaughtered. You look at, let's take Apple so far this year. Take a look at Apple stock. Apple stock this year. Let's go to year to date right here on Google. Apple stock is 5% down. So Apple stock is down 5% so far this year. We only been in like 1 week, so nothing to go crazy about. But you see how the market is down 2%, but Apple is down 5%. That means that, hey, if you own Apple, hey, in 1 week, it is underperforming the market, which is definitely nothing to go crazy about. Some people look at it quarter to quarter. Some people look at a year. I like to go by what Warren Buffett says. He says he looks at 3 to 5 years, right? So right here, this is what you look at with, looking at particular companies. So you're looking at the big tech companies like Apple and things like that. How are they performing? So ask yourself, what is going up? What is doing well? And why is it doing well? So let's take a look. Let's take a look and see who's doing well and why are they doing well. Before I get into that, let me see what's going on. What's up, Bank? Bank says, shout out to my man Prince. I look forward to learning the business. He said, I need Prince. You need Prince. Let's learn how to make money and protect our money. Prince, way or no way. Salute. Appreciate that, Bank. I got to give him a $sign for that. Dropping gems, Bank got a lot of experience, with, life experience. Now he's 53 years old, coming back, and I always ask myself, man, how would you start? And I take it as a project to say, if you was 53 years old, starting, from scratch, how would you slowly build yourself, right? How would you build yourself? How would you create a business? How you join your business? All this stuff like that, right? So here we go here. Let's look in here. What's going on? Antonio, my guy. Antonio, I think Antonio's out of Pennsylvania, right? So Antonio, he says, Happy New Year, investing family, right? What's going on, Antonio, man? Glad to see you. This is the first live of 2016, right? So let's go. We're catching up. What's going on the year. Lucky's mom says, hey, Prince, glad you're feeling better. Yes, definitely. I am feeling better. I want to give an RIP to my guy, Sam Gilstrap, man. While I was down with COVID, I got a message that he passed away, and we served together in the Navy out in San Diego, California, right? And, his mom said, hey, he passed away with COVID. And I was like, wow, I'm sick. I'm homesick with COVID. That did put a shocker to me. So definitely I want to give a rest in peace to Sam Gilstrap, man, who just passed away from COVID. Very great guy. All right. Lucky's mom says, good evening, everyone. How you doing? Lucky's mom. She's down there in Duval County, Jacksonville. Florida is in the building. What's going on, Jacksonville? Glad to see you, Lucky's mom. And look at my guy, Al. That's my guy, Al. He said, my guy, Bank. Yes, sir. Let's learn and help each other. Okay, cool. All right, ladies and gentlemen. Now ask yourself this question. As we just talked about, let me bring myself up for a second here. We just talked live. Y'all hit the like button as y'all coming in. Or if you're already here. We just talked about the, S&P 500 going down so far this year at 2%. And we talked about the S&P 500 finishing the year great at 27%. And how it is the benchmark of finance. That's why I'm bringing it up on this particular show. And the S&P 500 is nothing but the top 500 companies in America that you can invest in by purchasing the ETF or purchasing. You could do it through a mutual fund, things like that. But let's talk about what is doing well. Here we go, ladies and gentlemen. What is doing well? What is outperforming the S&P 500? Here we go. Financial industry rise. Financial industry has had a rise. Let's take a look here. Let's take a look here. Let's see the financial industry rise. Why is it rise? I'm getting ready to share my screen with y'all. All right. Let's see. Okay. Why are we seeing this rise? So we talked about the market being down 2%. Let's go back in here. Let me pull up the screen here again. Now we're going to take a look at XLF. XLF, ladies and gentlemen. This is the pretty much an ETF that tracks the financial industry. Companies like your Bank of America, I think JP Morgan is in there, all those type of companies, right? I could pull that up later. We could take a look at it, but I know most people, that's kind of besides the point of what's in there. Let's take a look. So far this year, you can look at the financial industry is up 4.15%. While the S&P 500 is at 2%, the financial industry is at 4.15%. Let's take a company like JP Morgan, JPM. That's the stock symbol, right? Let's see how they perform so far this year. JP Morgan is up 3.38%. Let's take a look at Bank of America. Bank of America itself is up. My bad. Maybe should I go back to the year? So far this year, Bank of America is up 6.5%. Bank of America is up 6.5%. Let me go back to Bank of America. I don't know if I hit the right button there on year to date. Make sure I think I did. Yes, they're up 3.8%. JP Morgan is up 3.8%. Bank of America is up 6%. The entire financial industry XLF ETF is up by how much? 4%. 4% is not a lot, but it is a lot when the entire market S&P 500 is down 2%. Let's look at the other two major index we have is the Dow Jones. Look at the Dow Jones. How well is the Dow Jones doing so far this year? Dow Jones is down by 0.92%. Let's look at QQQ. You know, this is the NASDAQ. How far is it down so much this year? As you can see, NASDAQ is down 5.43%. Sorry about that, y'all. I want to pull up one more thing. I should have had this already pulled up. Y'all give me 1 second. I'm going to pull up the real estate industry. And we're going to talk about something. Why? As we look into the real estate industry as well. So this is called sector rotating. So when I'm looking at the particular sectors, I'm wondering what sectors are rotating. Right? Who am I looking at here? Where am I looking at? Give me 1 second. I think that's the staple. Now, give me 1 second. I'm just getting my symbols together. That's a consumer staple. No. X. That's material. Yeah, let's take a look at XL. I know. Oh, crap. I know what it is. I know which one it is. I can just look it up right here. Let's look at the real estate ETF. All right, so we're gonna look at this to see which one it is for real estate here. No. VNG, that's a Vanguard real estate ETF. Let's take a look at it. That's good enough. Not the one I'm really looking for, but VNQ, I think that was right. VNQ stock. So this is Vanguard. This is Vanguard's real estate index fund, right? How they're doing so far this year? Look at real estate. Their real estate ETF is down 3%, right? Now let's look at consumer discretionaries or consumer staples, some like to call them. Now, why is this important? You have to look at the market and you see the Dow Jones is down, S&P 500 is down, NASDAQ is down. Now you got to ask yourself, what sectors are moving up and it has an upward trend? And why do they have the upward trend? Then once I see why they have the upward trend, I look inside and see the particular companies and see who inside of that sector is having that upward trend to kind of discover potential pockets of, because they always say, even in the bear market, there's always a bull in the market. You just got to find it. Or you just don't know where it is. So let's look at consumer staples, XLP. I should have had all these symbols written down, but they're on my phone. So XLP stocks. And I'm not good enough to remember all of them off the top of my head at times. So consumer staples are up 0.42%. Consumer staples, they got a little nudge so far this year. Let's take a look at which one is this one here? Consumer. Let's take a look at healthcare. Let's see what healthcare is doing. XLV. Okay, this ETF healthcare. Healthcare so far this year, it is down 365. So let me see if I can find my consumer staples or discretionary. We already know technology is down. It's one of the worst ones. Well, let's take a look at a very interesting one, materials. Y'all know materials are very hard to find. Let's look at that industry. All right. How's it been performing so far this year? Had a nice jump up, but it's down 0.15%. Nothing too crazy. And now I want to look at that one. We already looked at that one. XL, I think is XL. Let's take a look and see if I can find it. I'm looking for consumer discretionary. Consumer. I'm gonna look at consumer staples. Yeah, there we go. Is that XLP? I thought we just looked at XLP. Let's take a look at XLP again. I think we just looked at it. Yeah, that's the one we looked at. Consumer staples. So consumer staples and financials are up when majority of all the ones major indexes are down. Why is that? Ask yourself that question. Now, the people who are tuned in live and who's watching me go through all of this, they're probably looking at me saying, Prince, so what? We just watch you pull up the S&P 500, show the S&P 500 returns. Then you turned around and went through all these industries. You went through real estate. You looked at the real estate ETF, the healthcare ETF, the consumer staples ETF. I went and look up consumer discretionary. That's the one I want to look up. Consumer discretionary. Excel consumer discretionary. Give me 1 second. XLY. So let me take a look at XLY. So XLY, it is down 5%. This is consumer discretionary. Let me show it to y'all so y'all can see what I'm talking about. So look, consumer discretionary is down so far this year. Consumer staples are down. Tech is down. Healthcare is down. Everything is down. But I see financial industry is up 4%. Consumer discretionary is slightly up. Dow Jones, S&P 500, everybody's down. Why is that? What is the market trying to tell us? Why are these particular industries are up while everything else is down? Ladies and gentlemen, here we go. What is it? Inflation. I wish I had my drum roll. Inflation rates, right? Well, not really inflation. Let's go back to this. Rate hikes. The Federal Reserve is set to meet on Tuesday. For people out there who's not familiar with the Federal Reserve, Chairman Jerome Powell, he's set to speak on Tuesday. He is the one that controls the interest rates. Historically speaking, when interest rates go down, when interest rates go up, stocks go down, right? When you see interest rates go up, stocks go down, because as interest rates go up, the interest on money becomes harder to borrow. I didn't even show my shirt today, y'all. Shout out to my guy. I am weird. Shout out to my guy. V&T Designs sent me this. Shout out to V&T Designs. Came down to my office and my wife had a on there. She had a package on my desk, and I went in there. They had a design coin, the design shirt for me, some wristbands that I'm wearing. I said, you know what? I'm getting ready to do a show. Which way to bring back into 2022 than to do this? So, ladies and gentlemen, we have a rate hikes coming up. The Federal Reserve hinted last year that they're going to raise interest rates by at least 3 times this year, is what they're projecting. Why does the Federal Reserve talk about raising interest rates next year? This ties back into because of inflation. Our inflation rate right now, the last CPI report, the CPI report is the Consumer Price Index. The CPI report is based upon what, right? The CPI report is based upon, that's our inflation, Consumer Price Index, the price of goods and services, how they go up over time. Let's take a look at that. So you don't have to, if you're ever wondering how to get to it or anything like that, let's go fishing. Where is my consumer price index? There we go, right here. You get this from the Bureau of Labor Statistics, ladies and gentlemen. You can look up the consumer price index. So right here, it tells you right here, the consumer price index is a measure of the average change over time in the prices paid by urban consumers for a market-based consumer goods and services. Right. So I read that in, just in case you never heard of it before, this is on BLS.gov. This is the United States Bureau of Labor Statistics. So here's a chart here below. We see the section that has the highest interest in inflation rate is energy, right? All items, they're at what, number 2, but you see interest, you see energy is just running crazy with inflation prices, followed by food. So the latest numbers right here, you can look on here, the consumer price index, inflation went up 0.8%. So now, ladies and gentlemen, you're looking at it here they'll tell you right here on December 10th. In November, the consumer price index for all urban customers rose by 0.8% on a seasonal adjusted rate, raising to 6.8% over the last 12 months, right? So you look at the last 12 months, when you got the cost of goods and services going up, why is that such a bad thing? As interest rates go up, the dollar goes down. The value doesn't keep the same. So yes, you're making money. You might be making more money, but guess what? Your dollar can buy less and less. Why? Because the price of everything is going up. For prime example, what good is $100 if a loaf of bread costs $50, right? So if a loaf of bread only costs $1, or milk, let's say if milk costs $2 a gallon, versus if it costs $80 a gallon. If it costs $2 a gallon versus $80 a gallon, that your purchasing power, that's what the technical word for it, goes down if it's $2. If the price of milk goes up, your purchasing power, what you can buy with your dollar, is going down, aka mean the value of the dollars continue to drop. So the Federal Reserve sees it as a problem, and they're looking at what can we do about it, right? But the Federal Reserve, you can see they have two things going at the same time. Ladies and gentlemen, number one, we're in a pandemic. Number two, they're looking at the jobs reports. Prince, how does this make sense? So you have inflation that high that we just looked at from the Bureau of Labor Statistics. The Federal Reserve comes in and said, hey, you know what? We need to raise interest rates. Because when the pandemic hit, if you guys and girls remember, the Federal Reserve, let me show you guys and girls where you can get the Federal Reserve information. Let me pull up the Federal Reserve website. This is where they're going to be an open market. They're going to speak on Tuesday. Here we go. This is where you can go get the information from every meeting, right? The Federal Reserve, they talk about their meeting. This is where I can get all the information. I can look at their PDF, see exactly what they said at their last meeting, right? It tells me who was at the meeting. Here's the entire transcript of what they thought about the meeting, everything, right? These are the people who are deciding what the interest rates are going to be. And when they raise interest rates, this is why you see stocks cool off, ladies and gentlemen. As they raise interest rates, you're going to see stocks cool off. Now, tech stocks got it the worst. Why do they have the worst? Growth stocks usually hit the hardest when interest rates rise. So when you're looking at what the market is telling us, you're looking at the NASDAQ is down the worst. The NASDAQ is the one that creates the most volatility per se. So ladies and gentlemen, when we look at all of this information, what is this telling us the market is anticipating? You're watching stocks go down, 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 but you're watching the financial industry and consumer staples go up. This is telling you that they are looking for interest rates to rise, but inflation to kind of still be high. So when interest rates started to rise, who benefits from rising interest rates? Banks. How do banks make money, generally speaking? They have a bunch of ways. They sell products and stuff like that too. But the number one way they make money is by charging you interest and loaning it to somebody else for a lower price. We all know that. You come in, you save your money. The average, I think the last time I looked at it, the average savings accounts, ladies and gentlemen, is 0.06. So you save your money. The bank gives you 0.06 for your money. So you give the bank $1, they give you 6 pennies for saving your money with them. But then again, the person that comes in to borrow $1 from them, they charge them a dime. Your credit card, notice your credit card with Bank of America is probably roughly 10, 15, 12%. But when you give your money to the bank to let them to save your money, they give you pennies. That's how they make their money, that space in between. So when they are the least amount of money that they're charging you to save your money, it's a gap, right? You save your money, they give you 0.06. I go to take out a personal loan, a loan to start a business, anything, they charge me 10%. So you do the math, that's a 9.94% rate that the bank is making off other people's money. So banks benefit when interest rates go up. This is why, in my opinion, why you're seeing, when you're looking at the data, knowing what you know now, or knowing what you already know, then you look at the data, you're seeing, why is the financial industry going up? Financial industry is going up. So what? The market is anticipating interest rates to go up. The Federal Reserve told us this back in December. I did a show on this and said, hey, Federal Reserve talking about raising interest rates 3 times. Take a look at the financial industry. And now we're seeing the financial industry and bank stocks starting to go up. What is the market telling me? We're seeing everything else go down. What makes the stock go down? That means that people are selling it. They're selling one thing. What makes something else go up? They're buying something else. Money is like energy. I can't remember the exact physics. I should have paid better attention in high school and physics and in college. But money cannot be killed or destroyed like energy. Energy cannot be killed or destroyed. It can only be transitioned, right? So when you have a bunch of energy and you push energy somewhere, energy doesn't disappear. It just goes somewhere else, if that makes sense. Almost like when you push a car. The same thing with the financial industry and money in general. Just because your money is, you had $20,000 in your savings account and now you only have $10,000, that money did not disappear. That money now is with Nike and Amazon and Facebook and whoever the heck you spent your money with. So the money, just because it's not in your account, it didn't disappear, it just went somewhere else. Friends, what are you getting to? I mean, the market itself. When you look at the market itself, it means that the market itself, the money is moving. When you see, when I look up and I see the NASDAQ is going down, Dow Jones is going down, S&P 500 is going down. Then I take a look at the sectors. Healthcare, down. Real estate, down. Well, not down actual real estate, just the ETF in the past week, right? Oh, it's down. Everything is going down. What is going up? Oh, wow. Financials is going up. Consumer discretionary is going up. So now let's take a look and see what is inside of those companies to make it go up. All right. So let's take a little walk here. That's what I mean by that. In this, all of the gist of, as an investor, finding a place in the market at the time to figure out what the market is telling me and to say, hey, think about it, ladies and gentlemen, 2020, woo, I had a great time in tech stocks. 2021, not so much. Cryptocurrency started off great. Cryptocurrencies cooled off. What happened to them? When crypto is hot, everybody is just, woo, 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 look at me, I'm a genius. And then when I dropped that episode and I told everybody, I'm not going to lie, yes, I own SHIB. Yes, I made a bunch of money, but it's just a lottery ticket, right? And everybody, what do you mean it's a lottery ticket? SHIB is this, cryptocurrency is this, and this, and this, and this. Those same people gotten quiet when the market has gone down. I'm not quiet because I still stand on what I said in the beginning. When I purchased my cryptocurrencies, they were lottery tickets. Now, I believe in Ethereum now, as I'm learning more about blockchains and NFTs. I'm believing a little bit more in Ethereum and Bitcoin, the big ones. But those little small ones, this coin that's coming out every night, I don't know what those things are talking about. So now that we know the financial industry, you said, Prince, you pulled up this thing called XLF. What's inside of it? Take a look. I'm going to show you how to look it up, ladies and gentlemen. You go to Google. You type in XLF, which is the symbol. And we're going to look at the holdings. XLF holdings. All right. So inside of XLF, the companies that are inside of it, okay. Top 25 holdings. Number one, their number one holding is Berkshire Hathaway. This is Warren Buffett's company. Let's take a look and see how has Warren Buffett's company done this year. So far this year, how has Warren Buffett's company done? Let's take a look at it. Okay, let me go to the site. All right. So far this year, Warren Buffett's company is up 6%. We're going to take a look at this. Berkshire Hathaway, which is notorious for the greatest investor of all time, Warren Buffett. Maybe I'm doing too much here. Give me 1 second. Give me 1 second. Okay. Y'all let me know if y'all can hear me and everything. So here we are. Look at Warren Buffett's company up here. Berkshire Hathaway is up 6%. How did I know his company was doing well? I started to look inside of XLF, and there we go, right? Here we go. Let's take a look into the financial industry rise. So far this year, Berkshire Hathaway. Look at Buffett and his company having a great year, right? Their revenue in 2020 was $245 billion. They are the owners of, they got a Berkshire Energy, they got Dairy Queen, Geico, and a whole bunch of other stuff, right? So their largest holding in XLF is Berkshire Hathaway. Now let me go back to where we were. Give me 1 second. Where are we at? If you're coming in, hit the like button, hit the share button, tell your cousin, mom, and them. Unless you're watching football, then check out your football. You can watch this later, catch a playback. So right here, you're looking at the top two holdings are Berkshire Hathaway, JP Morgan, Bank of America, Wells Fargo, Morgan Stanley, BlackRock, Citigroup, Goldman Sachs, Charles Schwab, S&P 500 Global, American Express. So you look at these financial companies, and you're looking at, I can look at the top two holdings, top three companies, JP Morgan, Warren Buffett's company, Berkshire Hathaway, and Bank of America, right? XLF total net assets is $44 billion. That's inside of this particular fund, right? Tracking the financial industry, they're doing a good job. So I start to look inside of it. Now let's take a look inside of XLY's holdings. So then I look into those particular companies. I start to evaluate those companies. Then I look to see if these particular companies are they poised to have a great year. Right? I think this is XLP, consumer staples. Consumer discretionary is things that customers can buy when they have money. Consumer, they have a discretion to go buy more when the economy is doing good, and they buy less when the economy is doing bad or proceed to do bad. Consumer staples. These are things that are staples in our community, right? Well, not our community, but our economy. Let's take a look at what companies are inside of there. XLP Holdings. Let's take a look. There we go. Consumer staples. You got Procter and Gamble. You got Pepsi, Coca-Cola, Walmart, Costco's. Let's go on. Colgate, Kimberly & Clark. Things that we use every day. Toothpaste, soda, water, cleaning supplies, consumer staples. These things are just going to be here. Prince, why is consumer staples rising? Because no matter what's going on in the economy, people will drink Coca-Cola. No matter what's going on in the economy, people will drink Pepsi. No matter what's going on in the economy, people will brush their teeth. I hope so, with Colgate. People will smoke cigarettes, right? Philip Morrison, they're right here. Philip Morrison is a tobacco company. People will drink coffee. They will smoke cigarettes. They will, these are things that are staples in the economy that people will use regardless. Now, when prices of goods and services go up, these particular products, the toothpaste, Coca-Cola, they're going to go up. right? Potentially increasing their money, making them more money, right? Because it doesn't mean that it costs more to make toothpaste. In a way, it does, but this means that they can charge more for goods and services. So these companies' profit margin is set to increase by the price of goods and services increasing. And these are things that we're going to buy regardless. I'm going to buy toothpaste, not necessarily going to go buy soda, but I'm going to probably buy water. I'm going to buy rags, towels, things. You're going to use things that are made or created. Toilet paper is on here. All these companies, grocery stores, things that we have to use. Food, Cisco is in here. These companies that we use every single day. Procter and Gamble is this top 3 holding is Coca-Cola, Procter Gamble, and Pepsi. Let's take a look. Let's see how Procter and Gamble stock has done so far this year, and Coca-Cola. I know their symbol, so they just had it here. PG stock. Yeah, that's it. PG is their stock symbol. So here we go. Procter and Gamble, ladies and gentlemen. Procter and Gamble so far this year, they're down. They're down 0.1%. They're barely down, but they're down so far this year. Okay. Let's take a look at Coca-Cola. All right. Coca-Cola is up 1.74%. Not a whole lot, but it's up a little smidget. And what was Pepsi's stock symbol? I think it's Pep. Yeah, Pepsi stock. Up 0.64%. Not up too much. So Pepsi and Coca-Cola stocks are a little bit up. And they also, Pepsi, I don't know why Pepsi's always been in the NASDAQ. That's what's been kind of weird to me. But they're a little slightly up. But you're seeing the entire industry is a little slightly up, consumer discretionaries. So what does that mean? What is that telling me in the market, right? How companies are moving, right? How things that we are all using every day, their prices are going up. They're looking at the Federal Reserve to raise interest rates, and they're looking at banks to benefit from that. So you're seeing people who make money off of interest rates, their prices are going up too. So small cap to large cap, right? What do I mean by small cap to large cap, ladies and gentlemen? Small cap are companies that are small market capitalization, small money companies. So companies that I think is about 400 million and below are considered small. Large cap companies, mega cap companies, these are your Coca-Colas. Your small cap companies are your small startup tech companies. They're small. Large market cap are companies like your Coca-Colas, well mature consumer staple companies that we know of, Procter and Gamble, things like that, right? I thought that was my son coming in here. But anyway, what you're seeing is when interest rates rise, small cap companies start to struggle. Why? Who do you think benefits from borrowing money? Large companies or small companies? Large companies, in most cases, don't need to borrow money. Like you look at a Berkshire Hathaway, they don't need to borrow money, right? But a small startup may have a credit card. They may, Wesley, I knew that was him. Come say hey to everybody.
Hi, hey.
There you go. I knew that was you. I heard my door over there. I heard a little Wesley the rat over there. Why you like to come in here when you know I'm not live?
It's because I want to watch you.
You want to watch me?
I just watch.
See, come on over here. See, his shorts are not showing up. He got green shorts on.
Did you got?
See, your shorts are not showing up because you're not showing up on a green screen. This is my 10-year-old son Wesley here.
See, looks like my hair.
I see. You cut you in half because he got on lime green shorts. That's why they're not showing up. But anyway, Wesley.
Mm-hmm. Did you do a meal on Friday?
No, I didn't do a show on Friday.
Because you missed it, right?
What you mean, miss what?
The meeting.
Oh, I had a meeting. This is not a meeting, Wes. This is me on my live right now.
Oh, you did on Friday, right?
Yeah.
Okay.
Well, now he's gone. So, hold on one second. So anyway, ladies and gentlemen, small cap to large cap. Small cap companies are companies, small companies, startup companies. When you're trying to start your company, they usually borrow a lot of money to expand, right? Larger companies usually don't borrow money or borrow little to no money. Some of them still borrow money, but they don't use as much money. So when interest rates go up, you saw the bank stocks going up. Small companies have a harder time versus large companies who have large cash piles. They seem to do a little bit better because all that borrowed money just became more expensive. And companies with largest amounts of debt, like look at Facebook, pretty much practically zero debt. But look at some of these smaller startups. They probably are going to have a lot of debt on their company because they borrowed a lot of money to get started. They had to pay employees, pay for marketing, pay for this, pay for that, pay for that, right? So you're seeing a lot of people rotate out of small companies and go into larger companies. Smaller companies become more riskier as interest rates start to rise. How many companies that was already small can afford, hey, I have a line of credit with my bank, and my line of credit costs 12%. Interest rates go up, now that same line of credit is 15%, right? And small cap companies are naturally more riskier because they can go out of business. The smaller guy is probably going to go out of business more than a larger, mature person, right? Let's take a 60-year-old person who's financially savvy and who's been in the workforce for 40 years and who has all type of pensions and retirement set up versus the little 16-year-old. The economy hits hard time. The young people are probably going to be the ones who are going to get hurt the worst because the older people, they're probably collecting a pension. They probably got Social Security. They probably got this and that going on, right? So you're seeing people. So if you have a 401k, you look inside of your 401k or sit down with a professional to look at your 401k, and you can see people are starting to slowly move out of small cap. Well, I want to see you can look at people, but it's me in my head. I tone it down a little bit on my small cap, right? The larger companies are set to benefit. Your Bank of America's, your consumer staples that we saw, they're the ones that's kind of ticking up a little bit. All right. So anyway, ladies and gentlemen, now the other big thing is the jobs reports. Let's take a look at it. I think I had it pulled up here. I do have it pulled up here. Let me share the screen. Here we go. This is the last jobs report that we had that came out on January 7th, right? So it's telling that this is the weekly jobs report. Every week, all they do, they look at employment roles, unemployment rate declined to 3.9%. So right here, this is our new unemployment rate. Unemployment drops to 3.9%. So, ladies and gentlemen, the Federal Reserve, they're looking at unemployment has dropped to 3.9%, but inflation is at 6.8%. Federal Reserve, what are they going to do to combat this? They're going to raise interest rates. This is why jobs reports are important when you're doing your financial data. Ladies and gentlemen, I'm on BLS.gov. This is the employment situation report that came out on Friday. Unemployment has declined to 3.9%. The last inflation report that came out on December 10th, it said inflation was at 6.8%. And I'm pretty sure when the next one come out, it's going to go up to it's probably going to be at 7%. The Federal Reserve is going to have to raise interest rates. Once they raise those interest rates, what does that mean? Tech companies are going to start to get hit hard, right? Growth companies, growth stocks, growth and tech companies are probably going to get hit hard. Financial consumer staple companies will probably be poised to do a little bit better. As those interest rates rise, it makes money a little bit more expensive for small cap. So you're going to see people slide out of small cap and maybe looking at large cap. Ladies and gentlemen, this is called rebalancing. Rebalancing, right? And on my show, why do I pull up this information? Because I don't want you to talk about, hey, some goofy looking guy on YouTube, Facebook, or a podcast said this. I want you to know that you can look this information up too. I bounced around from Bureaus of Labor Statistics. I bounced around from different websites, showing you how I found this information and came to my opinion. Right? Let's see what we got going on here. Also, you see, next week, what's up next? Federal Reserve, Jerome Powell, he's going to speak on Tuesday. I'm almost guaranteeing he's going to raise interest rates. Stephen Wonder could see that. Interest rates, unemployment dropped down to 3.9% since Friday. And also inflation at 6.8%, probably going to go to 7%. He's going to have to raise interest rates. It's pretty, and the economy knows that. That's why you're seeing these certain things go up. Also, on top of that, earnings kick off next week. Shout out to earnings. You asking the question, what are earnings? Corporate earnings, right? What are corporate earnings, ladies and gentlemen? This is when corporations open up their book. Quarter one, a lot of 10K reports, 10Ks are the annual reports, 10Q are the quarterly reports. This is when companies are going to start to open up their books and start to let you know this is how much money we made, this is how much money we lost. And this is when you can see stocks going up or down or whatever. I think retail will do pretty good. Since the Christmas season did pretty well, I think retail will do pretty good. Always starting off first is the financial industry. JP Morgan, everybody's going up, right? So earnings season is next week. The Federal Reserve is speaking next week. So that's why we have a crazy week that's coming up. That's what's coming up. So ladies and gentlemen, I've been on here about an hour now. I got to roll up out of here. Do a little recap. I didn't even get a chance to jump into my Uber stock. Let's jump into Uber stock before I get out of here. So where are we at, Uber? Let's take that one out. Let me bring up my tab for Uber. As you guys and girls know, I've been a big component follower of Uber now for years, talked about it on the show for the last 2 years. And you look at Uber, right? Last year, it had a horrible year. Let's take a look. Let's go back 1 year. January last year, you're talking about Uber started out at $53 and it dropped down to $41. That's almost a 20% drop last year. But the company turned around and became popular. Not popular, but it's a household name. Uber is a household name. Uber became profitable, right? Has a market cap of $80 billion. Now profitable, but it's only $40. How does that make sense? But the competitors, Lyft, who doesn't make as much money, DoorDash, who doesn't make as much money as Uber, is way higher. Let's take a look at what is Lyft stock. Let's look at the competition. Lyft is $43. Okay, wow. Lyft is really falling down last year, right? So Lyft had a worse year than than Uber did, DoorDash. Reason why, if I was to go into this entire sector, Uber is a three-headed monster. It can give you a ride, pick up your food, and it can deliver stuff with transportation, freights, I mean to say. DoorDash is just food. Lyft, why does Lyft have such a bad year? Coronavirus. With a pandemic going on, people are not getting out as much. People are not going to as many events. So the revenue for Lyft is killed. Uber too, but Uber has Uber Eats. Uber Eats has been the saving grace for Uber. So Uber Eats is $41. Uber Eats is making more money than DoorDash. It's bigger than DoorDash. But DoorDash is $132 versus Uber stock is $41. DoorDash market cap is $45 billion. Uber market cap is how much? $80 billion. Does that mean Uber is significantly undervalued? In my opinion, yes. When I look at Lyft, right, who only makes money one way and it still costs more, and its stock is $43. DoorDash, $45 billion. All it does is just gives you food. It's not even bigger than Uber Eats. Uber Eats is bigger than DoorDash. Makes more money than DoorDash. But DoorDash is $132 while Uber is $80. $40. Doesn't make sense. When I see this, the only way I can make sense is undervalued. The market has not realized the value of Uber. Out of all these companies, who's the only one that's popular? Not popular, but profitable, makes money. Uber. What is $40? Very undervalued company, in my humble opinion. Well, that's it, ladies and gentlemen. I got to get out of here. Hopefully, y'all got some out of this episode. If you like the episode, you like this podcast, let me know in the comments. Hit the like button, or as you coming in and out. Thank y'all guys and girls for tuning in across the globe, and the people that's going to catch the playback. I really appreciate you. Hopefully, you learned something. Definitely haven't done so already. If you haven't done so, make sure you check out my book series, Teaching Kids About Insurance with Wesley Learns About Insurance, featuring NFL Hall of Famer Terrell Davis. Wesley Learns to Invest, my first book, and pick up Wesley Learns About Credit, but it is green and it's not going to show up on its green screen. These are the hardcovers. You got the hardcovers, big, nice, pretty hardcovers. But if you want something a little bit more economical, we also got paperback. If you want it right now today, you can get an ebook or an audiobook. Also, all three of these books are now NFTs. So you can also purchase the NFT and get a 10% royalty split from my book series. So anyway, hope you guys and girls got something out of this. Definitely glad to be back. I'm a little tired. I don't know why. I'm a little drowsy, but it'll be all right. But hope you guys and girls got something out of this. We're going to see what's going on in the market. And I am back. I'm glad to be back. And I'm glad that you guys showed up in here. I want to say at the peak, I want to say it was about 14, 15 people that I saw that check this podcast out live. Y'all comments that came in. I definitely appreciate y'all. Let me see what y'all say in the comments before I roll up out of here. Kendrick Taylor, what's going on? Kendrick Taylor, that's my guy, Kendrick. He says, Uber will be huge. Nobody is looking at the freight side of the business. I agree. And I'm going to do a little bit more deeper. You know, I've stated to the end of the show, I'm going to do a little bit more deeper because I want to show everybody. DoorDash is $132. Uber is $41. DoorDash, all it does is deliver food, and it's nowhere near big as Uber Eats. So that lets me know nobody's looking at it right now. So anyway, you guys and girls enjoy the rest of your weekend. My name is Prince Dykes. This is the Investor Show. And to the next video, podcast, cartoon, books, or whatever else crazy you see me do around the globe. Peace. Be safe. I'm out. And thank you.